Tony, great to have you on this morning. If I follow your notes lately, you turned more cautious after the big rally up that you told us was going to happen. So what do you see as being some of the force behind the recent selling?
Well, you know, it's interesting. Corrections are only considered natural, normal, and healthy until you're actually in one. And when you're in one, by definition, it feels like Armageddon's coming. Otherwise, nobody would sell, right? So heading into that peak that we had a few weeks ago where we put out a note on a pullback, it was from excessive optimism, and you had some of the technical indicators suggesting that you were so overbought that you just couldn't stay there. And then, of course, when you start to correct, it kind of feeds on itself, especially when you have so much Fed fear and political fear with what the trade war looks like. So I think we're just setting up now. I would kind of transition from looking for a pullback to looking for another re-entry point.
Now, what to you does that look like, Tony? Because when you talk about things like sentiment that we're getting frothy, we finally picked up some ETF flows into equities again before we started selling. We got the event from Powell, but it didn't seem like he had the language markets we're looking for on the back of that cut.
Think?
Yeah, so my question is, how do you know where a sell-off like this ends, though, if it's a market that's been about valuation, expansion, and multiple expansion as opposed to earnings, big earnings growth expectations?
Well, I think as you know, Oliver, most of this comes from human nature. So what we have is our 4 key tactical indicators that had us looking for a pullback. Those are now getting oversold. So for example, the Investors Intelligence newsletter writers had bulls drop by 9%. One of the reasons we got cautious was you had 58%, 57, 58% of newsletter writers were bullish. That's a pretty high level. It's not as high as we were in 2018, but that's a pretty high level. That dropped 9 points in 1 week. That's a pretty sharp drop in sentiment. Also, when you look at the percentage of stocks, for example, trading above their 10-day moving average, that got down to single digit. That means more than 90% of stocks are trading below their short-term moving average. That's kind of a sign that you're kind of getting washed out. And of course, the VIX up above 20 is historically a sign that you're getting a little bit too much volatility. And guys, when you look, when you watch this, pull up a chart of the VIX, and what you'll see is you get spikes in the VIX that happen very quickly, but that spike is rarely, quote unquote, the low of any correction. So we think over the next week or two, you're probably going to see a little bit of a break of the low that we had the other day, and that should create an opportunity. However, what people don't really talk about is the positive side of all the trade war and the Trump tweeting and the economic slowing is much lower interest rates. We've had a decline in the 10-year note yield from 3.25 to 162, I think, before I came on. That is an extraordinary drop in interest rates that's stimulative because it allows a lot of the viewers to refinance their debt. And when that happens, you usually cash equity out and you spend it on something.
Hey, we see them refinancing mortgages like crazy this morning on the mortgage app print. But Tony, our history is fairly bifurcated in what cuts do for productivity and economic growth depending on which sample set you choose, right? 95, 98, it's good. 2001, 2007, it's not good. So is assuming low rates at this point by the Fed being positive for earnings growth something that depends on a view of how close we are to recession?
As you know, our whole bull story, we didn't disagree with the bear story that the economy was going to slow in the first half. That was the reason we were bullish, because it takes the Fed from being tight to being easy. Remember Marty Zweig's old line, don't fight the Fed. Well, why isn't it follow the Fed? Because we always fight it. It's human nature. So the whole bull story in the first half of the year was slower economic data. Now the bull story to get to our target next year at 33.50 is based on a reacceleration of economic activity that comes from more monetary stimulus from the global central banks, which is clearly happening, and you have the impact of the refi boom that comes with lower interest rates. So you want to see a reacceleration as we exit 2019. Just like the higher rates of 2018 created this slowdown, it wasn't just the trade war. I think the lower rates of 2019 is going to create the reacceleration in 2020.
So we've got your chart you pulled up about what happens after that initial Fed rate cut. How much depends, though, on follow-through language? As we speak, Tony, the president is lambasting the Fed chief again, that the cuts need to come. The bond market, in its own way, is lambasting the Fed chief, rallying bonds like crazy since his language. Yesterday, Bullard, to me, sounded like he's not ready to jump on the train to cut as a result of tariff-induced anxiety. Do you think Powell is going to want to cut and change his mind if the data outside of the tariff escalation doesn't change materially to the downside?
The Fed never wants to cut ahead of a market swoon. It's usually when you get a lot of pressure in the markets, both in the bond yields and the market yields, and the stocks going down, that it kind of scares them into thinking about it. However, I think this is a generational change. It's a really big thought in terms of my history of what I think is important to talk about. The Fed is going to become much more scared about disinflation and deflation than they are worried about higher inflation. They want a 2% average core PCE. It's at 1.6. It's at 1.6 with full employment and average hourly earnings going up. How can you have one of the best labor markets in the history of our country and have only core inflation at 1.6%? If that's getting worse because of slower economic activity, that's not going to create higher inflation. So I think the Fed is going to shift from being worried about that inflation like the 70s to more, I can't even believe the last press conference, but prior to that, he talked on Capitol Hill about not wanting to become Japan and now Europe. So if negative rates has now been proven to not work, you better get aggressive ahead of it. And we're at that pivot point where I think the Fed is going to have to get very aggressive, not because President Trump is tweeting at them, not because of any other thing than interest rates are going down and inflation expectations is going down to a point where you better be damn well scared you're going to end up in negative interest rate, and you better beat it to the punch if you can.
Now, Tony, when we look at the backdrop for the economy, to bring it back to the target price for the S&P 500 that you're looking at next year, because what I'm trying to figure out is throughout this earnings season, we haven't had any surprises to the upside on the forward basis, right? We've beaten on a trailing basis, but guidance is still basically flat and down from where it was at the beginning of the year for expectations. So what signs need to happen basically to suggest that's going to change? Because otherwise, a price target of 33 seems like a lot of multiple expansion on the way if we don't get big earnings growth.
So on DwyerStrategy.com, to give you a shameless plug, we did a piece called a post about a earnings revision mythbuster. We do these financial mythbusters. We look at what you're talking about. So my target is 33.50 next year. It's based on a 19 multiple, which would be a multiple expansion from current 17 times, and 176 in S&P operating earnings. The street expectation is currently $184 for operating earnings. So what I'm telling you and looking into the camera and saying is, as earnings disappoint in the out year, that's going to lead to a multiple expectations, which would make most people look at me and say, what? Well, the truth is, when you look at the history of this cycle and prior cycles, the multiple expands when the earnings revisions come down. The multiples contract when the earnings revisions in the out years go up. Think of the only two negative years this cycle, 2011 and 2018. Earnings revisions in the out years were going up aggressively. Why? Because you had too good an economy that was creating higher interest rates. Again, Oliver, comes back to the Fed. Don't fight the Fed. The Fed, when they're lowering rates, you get a multiple expansion.
Now, Tony, this has been the case. The evidence is there for sure to point out where maybe, this time will be different. One of the things we've talked about here a lot is some of the research that I've done on looking at sentiment, different ways to kind of gauge this since the Jan 18 high. To me, that remains one of the most important days of this market. We had the highest multiple yet of the bull rally. We had flows in the stock market like we hadn't seen before. We had the crypto speculation going nuts. It seemed like peak euphoria. If that euphoria never gets back there, will cuts be enough to juice sentiment and juice multiples?
Well, let's take our opinion out of it. Let's take my opinion out of it.
Okay.
What always creates a sustainable low is a drop in interest rates that's good enough to stimulate economic activity. As long as non-treasury credit is available, as long as banks and shadow banks are lending, then it's the drop in rates. So think about it as bumper bowling. You know, everybody knows what bumper bowling is, when you can't get it in the gutter ball. Above 3% on the long end, that slows the economy down, so you can't go into hyperinflation. At 2% and under on the long end, you refi the debt that was created in the prior years, which keeps you away from a recession period. Again, it's almost like we've had 3 mini recessions and bear markets this cycle. So you had 2011, 2012 European debt crisis. The rates came down, it stimulated growth. 2015-16 emerging economy commodity crisis, rates came down, the ECB started buying corporate debt, it stimulated growth, and now we have the current global manufacturing crisis. Germany's a mess, China's slow, rates are coming down, monetary policy is easing. The evidence shows historically that that should work.